Hello and welcome to our webinar today. My name is Barbara Claus and I'm a fund analyst at SCO, and I will be your host today. Today's theme is sustainable multi-asset portfolio. We have seen a sharp rise in demand for sustainable investments, and it's still high, not only for equity and theme funds, but also for multi-asset solutions. So why it's important to have a sustainable strategy for multi-asset solutions for many investors, as important for them is to achieve attractive return and moderate risk. So to tell us more about the possibilities, how to integrate all three aspects, sustainability, return and risk management into one multi-asset approach, we have two fund managers from Aegon Asset Management here today, Colin Dryburgh and Robert Jan van der Mark, who are responsible for managing the Sustainable Diversified Growth Fund at Aegon. You will also have the possibility to ask the managers your questions. So I would like to encourage you that if you have a question, just type it in the chat window on the right-hand side, either in English or in German, and I will get back to your question during the course of the webinar. Before we start with our discussion round with the managers, I would like to give you a brief overview over Aegon Asset Management for those of you who don't know the company yet. Aegon is a global asset manager and part of the second largest Dutch insurance group, Aegon. As at last year end, it has had 1,200 employees that work across Europe, Asia, and the Americas. There are 380 investment professionals managing 388 billion euros in assets under management. The company offers expertise in actively managed strategies, especially in fixed income, real asset, equities, multi-asset and solution, and it's also leading in responsible investment. In 2020, Aegon IM undertook global integration where capabilities were organized around 4 global investment platforms. This included the rebranding of the former Keynes Capital and TKPI funds into the Aegon IM brand. But now, let's welcome our expert. Hi, Colin and Robert Jan. Great that you are here today.
Hi, Barbara. Thanks for having us.
So I would like to start that each of you could tell me a little bit about your background and your roles at Aegon and the team you work on.
Sure. Shall I start?
Sure.
So my name is Robert van der Mark. Thanks for the introduction, Barbara. And I've been working at Aegon Asset Management already for 15 years and started off as a quant. So I have a quant background also. And then moved around 10, 11 years ago into the multi-asset team to really allocate the portfolios and manage the portfolios on a daily basis. And in that role have been responsible for many mixed and balanced funds, and for the last 5 years or so have been co-manager for the Sustainable Diversified Growth Fund.
And I'm Colin Dryburgh. I've been at Aegon Asset Management for just over 9 years, working the multi-asset team and managing multi-asset strategies. I've got more than 20 years experience in the industry, and prior to being involved in multi-asset, I was an equity fund manager.
So thank you very much, Robert Jan and Colin, for the little introduction. So I suggest to deep dive into the approach now. So your approach brings together, like mentioned before, the 3 key elements: attractive returns, sustainability, and diversification. So could you please tell us what each of these elements means to you in practice?
Yeah, sure. So let me move the slides a bit. So so we think that all these elements really tie together. So sustainability, diversification, and attractive returns. So as we all know, the world is facing some major environmental and health issues. Think about climate change, increasing extreme weather conditions, food scarcity, but also inequality and what we've seen in 2020, infectious disease. So what we do see is that consumer demand is changing. So consumers, especially millennials, are demanding change, demanding more sustainable products. So we see a demand there. And on the other side, we see geopolitics changing. So we have seen in Europe the Green Deal, which is mobilizing at least 1 trillion euros in the next decade, and also in the US, the Clean Energy Revolution and Environmental Justice Plan, which mobilizes about $1.7 trillion over the next 10 years, and more of these plans around. So what you see is that there is a lot of demand, that there are investment plans, so that this will also open up a lot of growth opportunities in the sustainable area, and a lot of return opportunities also aligning with that. So with aligning our fund also with sustainability, we think that also aligns with growth. And on top of that, it also reduces downside risk. So with aiming for sustainability, you avoid stranded assets, and also reduce the ESG risks in your portfolio. And that again also ties into diversification. So with diversification, we minimize idiosyncratic risks and also reduce downside. So all these three things really tie into each other and balance each other out into a robust portfolio with attractive returns.
Thank you very much for walking us through your three goals. And looks like they are going well together. So they are quite congruent. It looks like, so which is good. Another thing which I think is challenging about a fund is the return target. You have a return target of 4% per year, and I think in the current environment this is really challenging. So could you please tell me how your return target is met and what your major return sources in your fund are?
Sure. Well, you're right. It is a challenging target. And in fact, it's a target of inflation plus 4% annualized over the medium term. And we have delivered on that target. We're also looking to do that with less risk than equity. So typically between around half to 2/3 of equity market risk. This slide here shows you what we actually invest in and how we sort of think about the various sort of building blocks of the portfolio. We've listed on the right hand side the sort of purpose of each of these asset classes, and I think some of that's quite self-explanatory, but it's maybe worth touching on what we describe as alternative assets. So that's things like infrastructure, renewable energy, listed real estate. We view many of these assets as offering a return profile which is very consistent with our objective, i.e. attractive inflation plus returns. That's because many of these assets have got a contractual or a regulatory backed revenue stream that's inflation linked, and it's also they're also less economically sensitive than a typical equity. So that's very much a key part of our focus when putting this portfolio together, and that very much helps us to get to that inflation plus 4% objective. We can talk about the other asset classes in more detail as we go. I think some of them are much more self-explanatory. Our equity allocation is benchmark agnostic, it's total return focused, and obviously that's there to sort of generate growth and returns, with other fixed income asset classes then providing a range of diversification as well as return potential as well.
Thank you very much for walking us through the buckets the fund invests in. I think it's really interesting that you have alternative investments in there, and I think we will catch up on that question and the allocation later on in our webinar. But first, I'm curious how the allocation in your fund works and what drives the allocation.
I think RG is talking, but he's on mute.
Sorry, I'm here. Forgot to unmute. Sorry for that. Yeah, so the allocation, how it works. Well, asset allocation, as shown on this slide, is led by the multi-asset team. So we are a 14-person strong team, and making use of the 280 investment professionals that we have in-house, all the asset class specialists. So we form our views by using a range of inputs, looking across our, as we refer it, quadrant framework. So looking at fundamentals, valuations, technicals, market technicals, and sentiment. And then forming our views on which asset classes are most attractive. Then applying exclusion list. And then for security selection, we really work with all the asset class specialists, and they help us within each asset class select the best names that fit our objective and also fit the strategy that we want to invest in. And then the portfolio construction process, balancing risk diversification and return expectations into a robust portfolio. So maybe to highlight also that we are very active in our asset allocation. I can show you also the ranges of where we have been in the allocation for the last year. So last year, of course, was extraordinary with the coronavirus spreading over the world early last year. So we started last year with quite a high equity allocation, and you also see in this chart the dark shaded areas are where the allocation have been, so the ranges. And then the dots from small to large are recent to current allocations. So you can see just by looking at the ranges that we have been very active in the asset allocation. And maybe to give a bit of flavor on that, so last year we started with a quite high allocation, maybe 40% in equities. We started reducing the equity allocation and moving more into bonds, increasing the duration already in January last year and February. And thereby managed to reduce the drawdown in the fund quite a bit. And over time, May, June, until the rest of the year, we have been increasing that allocation again. And currently are back around 30%, kind of as we see, a neutral position where we have 40% in alternative investments, 30% in equities, and 30% across bonds, government bonds, credits, and cash. So that's the allocation at the moment. So it is quite flexible, and we use that in maneuvering our portfolio through also difficult times. Go ahead.
I think just before moving on from this slide, a couple of observations I would make, and that is that alternatives allocation does tend to be the most stable, and that is due to the sort of underlying stability of the assets there. The other thing is that cash range does look quite large. During the course of last year, we did use equity futures to hedge a significant amount of the equity allocation. So to a certain extent, that's exaggerating that cash position. In reality, our sort of physical cash balance would typically run at around perhaps 5%.
Thank you both for walking us through your allocation. Yeah, indeed, it looks really active, but it also looks like it's well diversified between the different buckets you invest in. So my next questions are also about the risk in the fund. So the next topic is diversification. So how do you ensure that your portfolio is well diversified? And also something that bothers me and also bothers the audience a lot is how you deal with the fact that return of traditional defensive assets like government bonds, for example, or cash, are still there near their historical lows and even negative in large parts for Europe.
Yeah, thank you for that question. So first diversification. So we have mentioned it a couple of times already. And I think a nice way or a tool that we use to look at diversification and diversification level is shown on this slide. So on the chart on the left, it shows our, as we call it, risk waterfall. And we have in this chart, we have ranked the strategies by equity market correlation from left to right. So the most left strategy is the highest correlated to equity. And then from left to right, the correlation turns even negative. And then this chart shows in one overview that the allocations are really spread across the different segments, also with different equity correlations, and that also allows us to reduce the total allocation and shows the diversification benefits on the complete right. And what you can also see and what is highlighted in this chart, that the typical equity allocation, so sustainable equity income strategy and the sustainable equity growth strategy are the highest correlated to equities, and that we have a large block in the middle of listed real estate, renewable energy, listed infrastructure, which we call the alternatives, which is much less correlated to equity. So that also gives us that diversification benefit that we need, and also has helped us in the last year reducing the drawdown quite significantly. And then maybe to your second question. So indeed, as you mentioned, that the traditional defensive assets like government bonds and spread categories have seen their return or their yield drop to very low levels, which of course makes it harder to diversify your portfolio in a traditional way, which always used to be with equities and then applying a mix of bonds to get that desired diversification level. So how we cope with that is really using these alternatives, which are usually cash flow backed and have also government guaranteed streams in some parts of the universe. So we try to allocate towards that. And secondly, of course, by using our active asset allocation, as shown in the previous slide, that helps us by taking positions and timing the positions at certain moments where we think that the market is more attractive also in these defensive assets, and then using them when we need them instead of just keeping them in and running with these very low returns consistently in your portfolio.
Thank you, Robert Jan, for answering the question on diversification. And I think it's a nice chart that here you can see that you have diversification benefits by including the alternatives. Even I think if they are listed alternatives, right? But yeah, but you have,
yes.
you have some.
These are listed investments, Barbara. That's correct. Yeah, because this is a UCITS fund that we're managing, so we're investing in securities that are listed with daily liquidity.
Mm-hmm. Thank you very much. Yeah, you can see that you have diversification benefits by including them. Before we move on to ESG, I would have one additional question, because we have also touched on the return target, and I would like to know whether you have also a risk target for the fund and what it is.
Yeah, so the risk target is half to 2/3 of equity volatility, and that's also shown in this slide where that level is. So we are running below that definitely at the moment. And on top of that, so on the overall risk management measures, we are running a UCITS fund, so we abide with the UCITS rules, and for that, so we also have an independent oversight and risk management team. So we basically have 3 lines of defense in our risk management and governance framework. That's portfolio managers, so us, tracking the risk level and making sure we are within all the limits. Portfolio risk management team and portfolio risk control teams, which check all the restrictions and check the risk level and also feedback that to us. And then finally, a third line of defense, the compliance and internal and external audit teams, which manage and track every risk that there is and make sure that we stick within the mandates.
Thank you very much for clarifying the risk targets for us. So the next point I would like to touch on is ESG. So I would like to ask you if you could walk us through your sustainability approach in the fund and point out to us what its key characteristics and elements it includes.
Sure. So to start with, from a corporate perspective, we're looking for businesses that are positively aligned in terms of their products or their practices with at least one of 6 major sustainability themes. We've listed them on this slide: 3 environmental and 3 social. So climate change, eco solutions, resource efficiency, sustainable growth, inclusion, and health and well-being. So every one of our investments is positively aligned with at least one of these themes. And on top of that, governance is an important factor that we consider for every one of our investments.
So just a little question, because I see we have 6 themes here, 3 on environmental and 3 on social. How do you include governance, because it's on the right-hand side in your approach?
Sure. These themes are typically about the business products or services. So looking at what the company does and how it does it. Governance is something which our independent RI team will assess as part of their overall ESG analysis, and that's something that's assessed for every security. So we do have an independent responsible investment team, and they're principally responsible for assessing sustainability and ensuring that securities match our sustainability criteria, which I can go into a bit more detail on the following slide. So we consider sustainability across 3 dimensions, and these are products, what a company does, practices, how a company does it, and also improvement. Does a company have an ambition, an incredible plan in place to improve over time? And that's very important from an investment perspective. So as I said, our independent ESG team, they do the analysis and they categorize potential investments as sustainability leaders, improvers, or laggards. And in this strategy, we only invest in sustainability leaders and improvers. Now, if we just look at the chart on the right-hand side, we've sort of graphically shown what we're discussing here. So the left-hand sort of y-axis shows the sustainability of different products, and the ones at the top are well positioned with structural growth and competitive advantage, and that's because they are inherently sustainable. So think of electric vehicles, renewable energy, etc. At the bottom of that axis, the opposite is the case. So these are typically businesses which are structurally challenged in some ways, for instance, oil, tobacco, etc. When we're assessing practices, that is much more about the ESG management practices of a business, and that's closely aligned to what many third-party sort of rating agencies would consider when they're assessing investment opportunities. So obviously we want to invest in leaders, which are the top right-hand corner of this chart, but from an investment perspective, it's very important to try and capture improvement. So that's companies that have perhaps got a good product but are improving their sort of management practices. And the reason for that is that improved management practices, improved operational efficiency often leads to better financial returns, and that in turn leads to strong investment returns. So there is very much a strong investment rationale for this sustainability approach.
So I have a question about the improvement you just mentioned, Colin. Why is improvement so particularly attractive? Companies to improve their sustainability profile, and are there areas of the market where you currently see a lot of improvements?
Sure. Well, if you just think about investing in any business, when a business improves its financial performance, that is generally a positive for investors in that business. And we very much believe that better sustainability credentials over time will drive better financial performance, and that is rewarding for us as investors. The areas that we tend to focus on and where there is a lot of strong improvement potential is within what we refer to as our sustainable equity growth allocation. And that is typically investing in mid-cap businesses that have got products which are addressing sort of major sustainability issues. So, for example, something called Cornet Digital is a manufacturer of sort of digital printing technology for the garment industry, for clothing. Typically, manufacturing and dyeing clothes uses a lot of water, generates a lot of wastewater, and can also generate a lot of pollution. This is a business which has developed a technology that minimizes the use of wastewater. It uses ink that is biodegradable, that is not harmful for the environment. So it's very much addressing a major sustainability issue in the world, and it's growing rapidly. And we as investors are benefiting from that growth.
So thank you much for explaining the importance of improvement to us. So companies that improved can have a higher dynamic, a higher growth. The next point I would like to touch on, which is something I come across a lot in ESG investing, that many people focusing on the E, on the environment, like, for example, looking at the carbon emission of their portfolio compared with the peers or the index. But you also look for social and governance factors. So you recently have sold Tesla, which is part of a lot of ESG portfolios or indexes I come across. So can you share your views here, and maybe also a little bit about you prioritize between the three factors E, S, and G, and how you assess companies like Tesla, for example?
Sure. So all of these factors are important. In reality, very few investments are perfect. So you will always be sort of balancing up various issues to do with E, S, and G. We're not prioritizing one issue factor over another. The Tesla example that you mentioned is interesting. That's something that our equity team were very positive on several quarters ago on the basis of its product. It's got a great product, very strong competitive advantage, and we invested in the company on that basis. One concern that our ESG team did have was governance related, and specifically around the board's lack of control effectively over the CEO. So you may remember that Tesla earlier this year made an investment in Bitcoin, and that prompted us to review that stock, partly because Bitcoin is considered to be not an environmentally sort of friendly asset. It uses a lot of energy to create Bitcoins, and when our ESG team reassessed Tesla, that actually wasn't the environmental impact of Bitcoin. They viewed that as being reasonably sort of minimal in terms of the overall company. However, it did highlight the lack of control that the board had over the CEO. And just as an example, the board members previously were not able to get professional indemnity insurance, and the chief executive actually had to pay that personally to keep them on board. So that story got to a stage where we felt increasingly uncomfortable with the governance, and we sold out of the stock on the basis that our ESG team downgraded that from an improver to a laggard.
Thank you very much, Colin. I think Tesla is an excellent example that ESG is not only about the environment, but also on governance. And I totally understand that point also with Bitcoin investment and the twittering, where Elon Musk moves the market with the tweet. So I totally understand, and I think it's an ideal example for ESG analysis, and that you have to do also the groundwork and the qualitative analysis, not only just looking at the numbers or carbon emissions of a company. This will also lead to my next theme. how you measure the effectiveness of the ESG approach. So I would like to ask you whether you have certain targets, certain ESG targets, which areas you look at, and maybe how your reporting is structured, because I know that most reportings also focus on the environmental part, like carbon, risk, or waste. So what is your approach to ESG measurement and reporting?
Sure. So this shows the current positioning of the portfolio based in the top left-hand graphic in terms of leaders and improvers. So we measure every single one of our investments on that basis. I also did earlier on mention the themes that we're looking to get exposure to, and the lower graphic shows the various themes that we're currently exposed to. These are simply, the weights of these are simply outputs. We are not targeting a specific allocation to a sustainable growth or climate change, etc. These weights are very much based on the investment attractiveness of different underlying securities at any one time. So I would say that these charts here very much encapsulate how we think about the portfolio from a sustainability perspective, and that's what's important to us.
And I think maybe one thing to highlight indeed also on this slide is that you see that the majority of the holdings are improvers. So we are really tilting our portfolio slightly towards improvers to capture that growth and capture that opportunity in the universe.
Now, Barbara, you also did touch on a climate carbon output, for example. We are not targeting a specific amount of CO2 output, but compared to, say, investing in the broader equity market, the fund has got about half of the CO2 emissions versus, say, the MSCI All Country World Index. We do think that you do need to treat these kind of numbers with some caution, because, for example, a bank that is lending to unsustainable businesses, it may have a very sort of low CO2 output, but we wouldn't view that as an attractive investment from a sustainability perspective. For what it's worth, we also have, UN Sustainable Development Goals are something that many people talk about as a common language, I think, in terms of sustainability. We are not targeting specific sustainable development goals, but what we have done here on the left-hand side is shown the fund's alignment to the various SDGs, and that's using third-party MSCI data. And the blue bars highlight positive alignment, and the red bars highlight negative alignment. So here what we've done is we've compared the fund to, again, the MSCI All Country World Index, which is on the right. And the 2 points that I would make are that we're generally more sort of positively aligned to SDGs than the broader equity market. We've got significantly less sort of negative alignment than the broader equity market. Again, this is not something that we're targeting, but this is simply output, and hopefully it gives investors some comfort that we are doing something positive and consistent with our messaging.
Yes, thank you very much for walking us through reporting. Yeah, I think it looks really profound, not only focus on one part, but on multiple parts. And you can also see how the different SDGs play together, that no company is perfect in all SDGs, but that you have a much better alignment than the standard index on the right-hand side. Next thing I would like to touch on, or I'd like to catch up on, is your portfolio. So you are currently invested with 41% in alternative investments, which is a significant part of the portfolios. So could you please tell us in which areas you are invested, And maybe also with keeping in mind that the universe has like a lot of utilities in there, which might not be overall sustainable. So could you therefore also please tell us how you deal with that fact that not all utilities are economically friendly overall, and how you assess sustainability for your alternative investments?
Sure. So first of all, on the utilities front, we do have some utility businesses within our alternatives allocation. For example, electricity networks, which are benefiting from the electrification of the economy. But within our alternatives allocation, we're very much focusing on entities that have got a large amount of renewable energy exposure, but also different types of infrastructure investment and real estate investment as well. So perhaps to bring this to life, we do have some examples of things that we have considered here, and that we're invested in a couple of these. Within infrastructure, for example, that does cover a broad range of different types of investment. INPP is a listed investment company which invests in a range of different types of infrastructure assets. So, for example, social infrastructure such as schools and hospitals, and that's clearly supportive for education and healthcare. Also, transmission assets for connecting offshore wind farms to the mainland electricity grid. And this particular example as well is also investing in a development of a sewer system in London, which is going to significantly reduce the amount of pollution in and around the London area. So something here that's got a lot of different types of positive sustainability characteristics, but also from an investment perspective, all of these assets are providing sort of predictable cash flow streams that are often directly linked to inflation and have got a very low amount of economic sensitivity. So I would say more bond-like in terms of cash flow stream than equity. Like, equities are very sensitive to economic cycle risk. So that's an attraction for us within infrastructure. Within renewable energy, our attraction, we've got something here called Green Coat. Often renewable energy companies receive either subsidies or some type of regulatory backed revenue stream, which is fixed and then grows in line with inflation for 10 or more years. So again, very bond-like in its nature. Sorry, my phone was going there. Bond-like in its nature and offering attractive dividend yields and return prospects. Just maybe sticking on the sustainability theme within alternatives, we do invest in listed real estate, but on the right-hand side, we have an example of something that actually we've not invested in. It's something called Sun Communities. This is a manufactured sort of low-cost housing company in the United States, and from an investment perspective, we were attracted to this because it has historically delivered strong growth, and we thought there was perhaps an affordable housing angle to this investment. When our ESG team looked at this, they very quickly identified that this type of business should have certain governance practices that were not in place, and it also should have policies around green buildings, energy efficiency, and it wasn't able to demonstrate any of this. So they categorized this as a laggard, and we've got an example here of something that we've not invested in for sustainability reasons.
So my next question is about the bond side of the portfolio. We've seen that bonds are not underweight in comparison to the overall range you can allocate to. So I'm wondering what's your view on the bond side is, and of course, really interesting question, what you think about green bonds, and why you don't invest there at the moment.
Sure. Well, why don't I just quickly touch on fixed income generally, and I'll let RJ talk about green bonds specifically. Yeah, you're quite right. As already mentioned earlier on, the prospective returns on most fixed income instruments are low. Currently, we've got about 12% in corporate bonds, and that's low relative to our historic range. We have been as high as 30%. So quite frankly, we do think that most bonds offer low returns, and for that reason, we've got a relatively low allocation, and within our government bond allocation, low duration exposure. That does provide diversification challenges for all investors, but as RJ mentioned earlier on, we do think that the bond-like nature of our alternatives certainly benefits us from a diversification perspective, and that's why we like them.
Yeah, and then maybe to add on that on green bonds, because we currently don't hold any green bonds in the portfolio, and that has there's two angles to that. So one is that we don't automatically think that any security is eligible, so also not green bonds. So all securities that go into the portfolio have been analyzed and graded by our responsible investment team. And a green bond can also be rejected based on any of the factors that are being assessed, so either product or practices, or based on governance lacking at the parent company. So it's not a certainty that they are eligible. And then secondly, of course, we also have to return targets. So we look at green bonds and assess them on their individual merits. And what we do see at the moment is that there is a lot of appetite for these green bonds, because some funds do automatically take them up in benchmarks and stuff, and there's a lot of demand there. So the spread levels haven't so far been attractive to us, as attractive that we decided to add them to the fund. We did have a green bond in the past, but not at the moment.
Okay, thank you very much for the explanation, Robert Jan. The next question about the portfolio is the COVID question. So what changes did you do to the portfolio post-COVID, and why?
Yeah, so maybe I explained this slightly earlier indeed, but we did decide early last year, already in January, when we saw the COVID virus emerging in China, we assessed it to be a tail risk, so nothing that we expected it to spread around the world as a base case. But with that tail risk in our minds, we already started decreasing the equity allocation in January and reducing the risk of the portfolio. And then once it really hit, especially Europe, we decided to also increase the duration in the fund, and held on to a very defensive allocation from March to, say, end of May. So with that, also reducing the drawdown significantly versus equity markets. Also maybe losing a bit of the recovery at the early start of the recovery, but we did manage to then, from May onwards, boost the risk level of the portfolio over time and do that significantly, which led to return above 10% last year in the overall portfolio, which we are very happy with achieving that in such a volatile year. And then maybe also in the equity sleeve itself, we did increase in this overview. It shows different strategies within equity that we have. So we have a growth allocation, which is higher risk, an income allocation, which is more quality type of stocks, which may be high, with some higher dividends also in them. And what we did is that during the start of last year, we increased the growth allocation quite heavily in the portfolio. And that also helped us during the COVID initial period when people were more working from home, so technology stocks outperformed, and really the growth stocks that we have in that bucket did very well. And then into the strength of that market, we have been reducing our growth allocation and increasing the income stocks more in the portfolio, so getting a bit more value in there, and a bit more defensive stocks. And that really started helping us early this year, where you saw the rotation from growth to value. But now, and you see that in the last part of the graph, very recently we have been adding back to growth again by reducing the income allocation again, just because growth has been lagging for half a year, and we do expect that move has been quite overdone a bit, overshooting a bit. So we have decided to start moving back into growth slowly, to try to capture that uptrend again when it comes.
So to sum it up, your allocation during the COVID crisis worked very well because you anticipated it early and positioned the portfolio accordingly. But then also after you gained more security that the worst is over for the markets, you added risk again in May. So you could benefit from the improvement of the market and achieve a return of 10%, which I think is really attractive, especially when we keep in mind that it's an allocation fund. So could you please speak a little bit about what drove the past performance, for example, last year and also in the current year?
Sure. I mean, we've got our performance chart here since May 2016, the inception of this fund. I mean, first, what I would say is that over the longer term, it's been a range of different asset classes that have been driving performance, and that alternatives allocation has been very helpful over the long term. RJ did touch on the asset allocation last year, so that certainly helped us during that drawdown period of Q1, where there were very few places for investors to hide. Certainly US Treasuries helped us a lot there. And then since then, it's been a combination, as RJ said, of re-risking the portfolio, but also tilting the risk into the right areas in terms of growth type assets during the second half of last year. They performed exceptionally well during the second half of last year, and as RJ said, they basically gave up some of their gains earlier on this year, but we managed to scale back the position in anticipation of that.
So thank you very much, Colin, for walking us through the performance. And now, as we near the end of the webinar, I would come to your outlook. So we have already touched a little bit on inflation, which is a huge theme at the moment, and the possible impact on some parts of the portfolio. But what are your general expectation over the coming years in terms of inflation and rates and the market environment, and how have you positioned the fund? And I'm also wondering, inflation and how it would impact parts of the alternative investments, like, for example, real estate, which is usually a sector that benefits from low rates. So could you please touch a little bit on your outlook on what you expect for the fund over the coming near term?
Yeah, sure. Yeah. So over currently, of course, we have just come out of the coronavirus, and with the vaccine rollout, you saw that economic expectations have moved up quite a bit. We think that has been reflected also in asset class prices, and therefore we think that most of the recovery in asset class returns have been are behind us. So also in that, we see that in our portfolio we have moved a bit more neutral, with 30% in equities, 40% in more stable alternatives, and 30% in bonds and cash. And we do expect, because indeed inflation has been quite a theme lately, we think that inflation will be transitory. So what you saw in inflation numbers also was that commodity prices last year were, especially in March, falling through the floor, and then recovered quite rapidly over the year, And then with all the supply chain issues, commodity prices overshoot slightly. You saw that reflected in inflation numbers. The inflation numbers year over year, especially 1 and 2 months ago, were very high. But that base effect will tail off in the next few months. So we also expect that will be visible in the inflation numbers, that these will also normalize slightly. And you don't really see a spillover effect into wages. So making the core inflation number move up quite a bit. That's not happening. So we do expect that's transitory. And that also ties into our longer term outlook, that we are still globally working with aging issues, which suppresses growth, huge debt in governments and households which need to be paid off, which also suppresses growth a bit. So in that environment where we are in these longer structural trends, and then investments in sustainability, we think that growth will be scarce. So having growth, and also in our growth portfolio, these assets will be highly demanded over the medium term. And that also, with all these sustainability investments, these opportunities will keep popping up. So irrespective of the medium-term outlook, we think that we are aligned with these growth trends and feel confident that we can achieve our objective by investing accordingly.
Yeah, Barbara, just touching on your point about inflation and, for example, listed real estate, I think you do make a good point there. And actually, the issue for something like real estate is not so much inflation in itself, but it's interest rates and the level of bond yields. So certainly when we're investing in our alternatives allocation, as we mentioned earlier, that does have a lot of natural inflation protection built into it. But we are very much looking for investments where there's a significant cushion in terms of the yield or the return profile versus government bonds today. So certainly, we've got a lot of investments that, in our view, would still look attractive if government bond yields were 1 or 2% higher than they are today, for example. Also within our equity allocation, we're investing in companies that have got very strong pricing power, which is important. And finally, I would say that this is a flexible mandate because of the sort of concerns that you sort of quite rightly sort of identify in terms of the potential for higher yields. We've currently got low fixed income, low duration exposure, and as we've said, we have flexed that allocation significantly in the past.
Thank you very much, Colin, Robert, Jan, for your outlook. So I think we have come to the end of the webinar, and I would just like to mention that we have got some excellent insights today on the strategy, on ESG investing, on reporting, on the outlook. So thank you very much for that and for being here today and answering all my questions. Also, thanks to all participants for taking part today. And I would just like to mention that you'll find the webinar replay, information about upcoming next webinars at Scope and Fund information on our website, www.scopeexplorer.com. I hope you enjoyed today's webinar, and I look forward to seeing you at one of our next Scope webinars. I wish you all a great day, and goodbye.
Thank you very much.
Thank you.
Bye.
Bye.